Yo, what's up, everybody? Good to be back for a stream after a 2-week hiatus. Unfortunately, and we'll just get this out of the way now. Um, I was sick the last time that I did a stream 3 weeks ago with COVID, and then I did last weekend about 16 hours worth of driving, plus running on like no sleep whatsoever, and I started a new job. I think all of that just kind of beat up my immune system. So then I got sick again, and this was whatever I currently have is way worse than COVID, frankly. So, um, if my tone of voice sounds horrible, which I am sure it does, that is why. And regardless, I think I will keep things kind of short and sweet tonight because I wasn't expecting to feel this crummy, but I also am like, I have nothing better to do than to hang out with my computer friends. So I might as well do that, right? Um, so, anyways, yeah, today was an interesting day because it was the Federal Open Market Committee, where Jerome Powell plus the rest of the Federal Reserve kind of addressed current market conditions, where the Federal Reserve is at with interest rates, money supply, balance sheet, all of that good stuff. Um, and this is, I believe, the first time that the markets have had like a really strong rally in the face of his comments. Lately, Jerome Powell has been kind of the Grim Reaper when it comes to markets and bullishness because of the fact that the Fed has been increasingly hawkish as to real inflation, right? So first inflation was transitory, and then it was kind of a serious problem, and now we have to entertain, some serious interest rate hikes and what's referred to as contractionary policy in order to kind of reel in this inflation and money supply problem and kind of stabilize things again. So we're going to kind of go over some of his comments, what that exactly means for markets, what that means for the economy, and all of that good stuff, and see, was this market rally today like a signal that things are going to be reversing after about 6 months of bearishness, or is there still some pain to come, which I think is a serious concern, especially given geopolitical issues and the supply chain constraints that are coming from that. As always, if you have any questions whatsoever, please feel free to ask them. I will absolutely make sure I address them. And like I said, this is probably going to be a little bit shorter of a stream tonight, but I still hope everybody has a good time, and I will stick around for as long as people are curious and asking questions and all of that good stuff. So feel free to interrupt me at any point, and yeah, let's get started. So I'm just going to go to this CNBC article that just kind of summarizes a few comments that Powell made, because I think a few of these things are pretty important. So first of all, there's going to be a 50 basis point interest rate increase, right? So this is the largest single interest rate increase that we've had, for one Federal Reserve meeting in, I believe, about 20 years. So it's pretty serious. And if you look at the federal funds rate, this is yet to reflect it, but right now it's sitting at 33 basis points, and it will go up another 50 sometime soon here. If you look at the U.S. interest rate, I believe this is already reflecting it. Yes, it is. So, right, we had our first increase in the middle of March. Now we've had another increase in the middle of May. And one thing that when Trump was president, he really made a lot of signals towards Powell and what the Federal Reserve would be doing or should be doing. But one common critique that a lot of people had is that we kept interest rates too low for too long on the recovery coming off of the 2008 recession. And if you see, we're actually getting pretty close to where interest rates peaked at before they started quantitative easing again. Now, we did not have historical inflation during this time period, and we do have historical inflation now. So I would not expect this to look just like this cute little 2-year bunny hill that we got going on here. I'd expect it to potentially go higher, as they don't know what neutral interest rate would be. Or if it doesn't go higher, I do at least expect it will stay consistent before starting to level off and back down again. Now, that doesn't necessarily mean that, we're going to have high interest rates for several years. In fact, I don't think that's going to be the case. But I do think that the most pain is probably going to happen in the short term, and then we're probably going to get to a more consistent spot. Other comments that Powell made is that we would potentially have 2 more 50 basis point increases. So that could look like, something like that. And he said that might be followed up with additional 25 basis point increases. So if we were to go further from here, that might make it to about 3% or so. So again, probably going to make it a little bit higher than we did over here, just due to the different market conditions that require that, namely unprecedented historical inflation. But despite that, it sounds like most of the pain will be over probably by the summer as far as interest rate increases. And when I say pain, for those not familiar with how interest rate increases work, this is the Federal Reserve practicing contractionary policy, which means they're making access to liquidity a little bit more difficult, right? Which means that it's harder to get loans and things like that. Just in general, the money supply becomes less liquid. So it's, harder for things like get a mortgage, interest rates are higher. Taxes are generally higher during these phases, but that's a tax policy isn't necessarily tied to what Federal Reserve policy is doing. And the idea is to make sure that the economy isn't overheating or growing at a more constant rate, right? Now, we go through these periods of expansionary and contractionary policy as to kind of ebb and flow the economy. You kind of get these little booms and busts is what they're called, right? So you just get these bunny hills, and we've bottomed out on our interest rate, but that is what it is. There are reasons for that get rather complicated. Probably won't cover that this stream. And then, a situation like COVID is when you practice something like expansionary policy, where there's stimulus, lower taxes, more financial breaks of some sort or another, easy for unemployment. What's up, Brandon? Good to see you, dude. So, right, you're expanding the economy as to increase demand so that people get out spending and kind of keep the economy chugging during times of uncertainty, right? And that's exactly what we saw during COVID. Max time of uncertainty, the economy was looking bleak. So our response was to practice expansionary policy, right? So we increased the money supply a significant amount in a short amount of time, about 42%. And as a result, the economy kept humming along, even though things were kind of scary. And, there's a lot of different ways you can look at that. One way is that you can look at the GDP, right? We had this massive decline and then a rather quick recovery due to that expansionary policy. Another potential way that you could look at that is the stock market, right? You had this drop because max uncertainty, and then we started making the money printer go burr and the stock market recovered. Other ways you can look at this is in the value of the dollar, which absolutely tanked during this time, right? It had a peak right before we began the emergency interest rates, and it went down 13% in its value as compared to other currencies in this basket. And since then, by the way, as we began practicing true contractionary policy, the dollar has just gone on a tear, right? And this is in the face of inflation, right? So if you're asking, okay, high inflation, rapid money growth over the past year and a half, why is the dollar rallying? It's because compared to the other currencies that it's being measured against, other currencies are inflating worse and their value is dropping worse, which is crazy to think about. Anyways, so the result of this is, okay, inflation is running hot because the economy is running too hot, bad financial decisions, the stock market's going nuts when it probably shouldn't be. So now we need to practice contractionary policy, where we increase interest rates, we soak up that liquidity, we potentially raise taxes, and we make sure, that the economy isn't running hot into bubble territory, and inflation isn't running insanely hot, and asset prices aren't going nuts. And we got to reel all of these things in, which is one of the primary roles of the Federal Reserve. Okay, cool. So with that, the markets rallied, which is crazy because for those that aren't aware, the markets have been looking real shaky since probably, depending on where you measure it or what you consider shaky, you could say we were seeing some signs of weakness as early as May of last year. But we were in probably legitimate bear market territory in November of last year. So about midway through quarter 4, suggesting that we've been in the bear market for about 6 months now. The definition of the term bear market is obviously kind of abstract. But more or less you could say that we've been in a downtrend, right? We are printing lower highs and lower lows, right? For about 6 months now. Okay. But today, markets everywhere rallied, right? The Dow Jones went up about 3% after this announcement. The NASDAQ went up about 3%. S&P 500 went up about 2.8%. And most interestingly, the crypto market rallied quite a bit today too. Bitcoin putting in about a 5.5% day. And you can look at any of these other ones. You got Amazon, you got Google, you got Apple, we got all that good stuff. So why is that, right? Because I talked about how we're, practicing contractionary policy. We're probably going to continue to practice contractionary policy for another 6 months at least, right? I think we're just going to continue to hike up interest rates for another 6 months and then maybe level off, and maybe we'll start to come down after that, but we'll see, right? So why did the markets rally? Is that rally going to be sustained, right? There's 3 reasons why the markets rallied. First of all is Powell's explanation on 75 basis point hikes in a single instance, his outlook on inflation, and 3, his perspective on a soft landing. Also, for those that missed the start, if my voice sounds weird, it is because I am sick. I had COVID last stream 3 weeks ago, and I have the privilege of being sick again. Super awesome. And additionally, because of that, I will probably be ending the stream a little bit shorter today. Also, if you have questions, please ask them, right? Okay, so the first thing is this 75 basis point hike. He said they're not entertaining doing a 75 basis point hike in a single meeting. Okay, markets really like the fact that they're not going to get that hawkish, that crazy about their contractionary policy, right? He did say again that they were probably going to have 2 50 basis point increases, and potentially a couple 25 basis point increases to follow after that, but no 75 basis point increases. So the market's like that. Okay. I'm just going to have to figure out how to delete all this later. Sorry that I'm just clicking around my screen like a madman. Number 2 is he said, as far as inflation picture, he believes that it is starting to top out and will level off in the short term, right? He seems pretty confident for the first time that this inflation thing is not going to be so nuts, or he's referred to it as transitory. And then he said, okay, it's causing some issues. And now finally he's like, okay, these basis point increase, this interest rate increases should make sure that inflation starts to level off sooner than later. I have a couple concerns about that comment, primarily the fact that we're still dealing with supply chain issues, and also the fact that well, not we, but Ukraine and Russia are at war, and that is causing additional socioeconomic problems as well as geopolitical problems and just a lot of uncertainty in general. So we'll see about this inflation thing, but Powell says that, these interest rate increases should cause it to level off. And third is that Powell said he anticipates that we're going to have a soft landing. What that means is that we are going to see a contraction in the economy, which we are seeing right now, right? GDP actually went down last quarter. So we can expect to see a contraction in the economy, but then followed by some steady growth. So a short-term contraction could be, 6 to 9 months, maybe a year, and then we start growing after that. I am going to erase all of this. Oh gosh, this is so slow. Sorry. I shouldn't have got as crazy about the drawing. This is totally my fault. While I'm doing that, here, I'll multitask. So why is it the mainstream media makes a big deal out of contractionary policies? Weren't home interest rates above 10% in the early 90s? Obviously, it's not good to pay such high interest rates with the dollar being at the value it's at and prices being high, but it seems a bit cyclical uh, by the decade. That's my observation. So there's a couple things to consider that get really complicated when it comes to interest rates and interest rates of the past versus interest rates of the present. One thing that a lot of economists would emphasize, and there's active debates going on with this, is the fact that more liquidity might be a good thing because it might continue to stimulate growth, and that might actually be healthy because of technological advancements. Um, but I refer to this as technological deflation, right? So the computing power that is in my smartphone, for example, cost significantly more, probably 10,000 times more back in the 1970s than it does today, and it fits in the palm of my hand. That's pretty cool. That's technological deflation. Another example is 20 years ago, what I'm doing right now by streaming and chatting with you and broadcasting, and I have this video camera and I'm sharing my screen and I got this nice microphone, right? Doing something like this would have cost astronomically more, right? Because I would have needed like an actual video crew and I needed a cable network to broadcast it to, and I probably would have to be some kind of professional in order to earn that kind of airtime in the first place. So all of these things decreasing in cost causes technological deflation, which is good. And we want to stimulate that to continue to happen. And one way that we can do that is by continuous technological growth. And we've seen a ton of that over the past 20 years, right? I mean, smartphones, by every stretch of the imagination, are an absolute luxury and a massively helpful productivity tool. I mean, the way that we've digitized so much logistics of just like being a human and being a professional in one thing, where you have a computer and a map and a cell phone and a calculator and like all of these thousands of things that you can do with just this little handheld device, right? Like we want technology to continue to innovate in that way and be accessible to people, and the only way that you do that is through making sure that growth is stimulated. The other thing is that, and if here, let me see, if you take a look at just interest rates in general, we're on this pretty steady downtrend with it, right? If you look at the federal fund rate in general, pretty steady downtrend. If you look at the value of the dollar, I'll zoom out to a monthly chart here. God, I sound terrible. I'm so sorry. Pretty steady downtrend, right? So if the interest rates are going to consistently go down and the value of the dollar is consistently going to go down, but inflation up until recently has remained in an okay spot and GDP has just done nothing but continue to grow, then the argument that a bunch of economists make is that this is not a horrible thing for the economy. And it becomes a bad thing for the economy when, you see obviously like quickly rising asset prices and inflation, right? Which is exactly what we're seeing, and which is why the Federal Reserve is entertaining increasing the interest rates again. My main concern with this, and my main argument with this, is that cyclically doing this increases wealth inequality. Many economists, I think, disagree with that stance. I've been told by several economists that that's, not really causal, and you can't look at it that way. But the main, it's just hard for me to think, okay, you flood the market with liquidity, right? You make money so much more accessible, and you're in one of two camps, right? You are either in, I need this money to live and pay off debt due to the hard economic times we're enduring, or I don't need this money, so I'm going to invest it or throw it, in the stock market or grow my business with it or whatever, right? You're in, I need this money due to a desperate situation, or I have this extra liquidity when I don't really need it. And, I mean, just imagine if you're a homeowner right now versus not being a homeowner, right? The extra liquidity in the market, you're either just barely, scooting by on rent, versus you got to refinance your home for a much lower interest rate, so your mortgage is cheaper. And on top of it, house prices just absolutely skyrocketed in the past 2 years, and you could probably sell your house for a pretty massive profit. In my opinion, that exacerbates wealth inequality, and you could extend this to very wealthy entrepreneurs now having all of these lower interest rates to take advantage of to invest, or a guy like me who has all this stimulus money, and I can throw it into Bitcoin, and that appreciates $10,000. Or there's people that need to buy groceries and pay their rent, right? Economists say that doesn't, right, that continuously devaluing the dollar and increasing or lowering the interest rates on this cyclical, downtrend, this boom and bust cycle, right? That doesn't cause wealth inequality. I don't know. I think there needs to be a little bit more research on that front because I'm not necessarily buying it. Okay, so the last thing that I wanted to cover for the stream is the market's response to Powell's comments, by the way. Because okay, this is a pretty serious bounce that we're seeing, and I'm gonna go to weekly here, right? One of the stronger bounces that we've seen for the midweek, right? Since we've kind of started this downtrend, we've seen, I sound so horrible with my congestion. I really apologize. I know it can't be great for you guys. 4% increase. Seen 5.4% increase. And now this week, if you're measuring from the open, we have a 3% increase. Or if you're measuring it from the wick, we have about a 5% increase. And we could continue to rally from here as well. So, pretty serious bounce on this news about the soft landing, interest rates potentially rolling over, and a limit to the hawkishness that the Fed is going to show. So, same thing with the crypto market, right? I mean, really nice bounce. If you look at the total crypto market cap, it's pretty legit too. But when you bust out the moving averages, which I think are really important to look at when you're considering bullish or bearish sentiment, we're still below all of these major moving averages, right? For every one of these indexes, right? The Dow is still below its 20-week and 50-week moving average. The NASDAQ is below its 20-week, 50-week, and 100-week moving average. In fact, it on this rally today, it came up to its 100-week moving average. So I would be very careful to see this become a point of resistance and potential rejection, right? Same thing. The S&P is beneath its 20 and 50-week moving averages, and its 100-week is crawling up. It looks like it might have caught that as support for a bounce. Dollar is rolling over a little bit as of this week, but this is coming off of one of the craziest tears the dollar has ever gone on, increasing about 9% over the past 6 months. And on top of it, it is well above its 20-week, its 200-week, its 100-week, and its 50-week moving averages, right? This congestion is no good. I'm going to try to stop complaining about it. I'm sorry. And then same thing with Bitcoin, right? Below its 20-week and 50-week moving averages and slightly above its 100-week. So they're all kind of in the same situation where they're getting wedged kind of between, two really key moving averages for long-term bullish or bearish sentiment, right? These are the type of moving averages that the Dow and the NASDAQ and the S&P 500 kind of consistently held on to throughout this bull run here, right? See, just very consistent support along this moving average that we've now lost, right? That's significant. Dylan, what's up? You're doing great. Thank you for doing this while sick. Yeah, it's totally my fault. I took the last 2 weeks off and I felt bad canceling this week. So I'm like, let's knock this baby out, right? So there's still a lot of room for caution, even though the markets rallied and got super excited about Jerome Powell's comments today. And look, this is how I see it, right? Is this the worst place to be dollar cost averaging and kind of getting back into the market? I wouldn't say so. I mean, Bitcoin's been in my buy zone for a while, right? I use these logarithmic regression bands. the bottom 3 bands I consider an area where it'd be historically good to buy Bitcoin, and the top bands are historically good areas to trade for me personally or sell Bitcoin. Again, this is not financial advice, that's just my personal strategy. So we've been in the buy zone for Bitcoin for me for a while, okay? And I mean, the Dow is down like 13% from its top, which is very significant for the Dow, right? Same thing here. I mean, 24% on the NASDAQ because, tech stocks are getting hammered, then industrial stocks, more than industrial stocks rather, and 16% for the S&P 500. So with that, these are not horrible places to be buying into the market, but I just also want to say that we should be exercising caution that it is more than possible that we can go lower still, right? So look, if you're not in the market at all, and you're thinking about getting in, I wouldn't personally stop you from getting into the market right now. We're down significantly and I mean, you look at tech stocks, they're down like crazy. Apple's hanging in there, but I mean, oh my God, with Netflix, right? I haven't seen a chart like this on a billion-dollar company ever. This is nuts. It's right after saying that about Facebook, right? Twitter's been going crazy. I mean, Tesla's all over the place, right? I mean, I wouldn't say these are the worst places in the world to be looking to make some buys, but you got to be careful, right? There's still plenty of downside ahead. If you're looking for targets on any of these, I mean, the 200-week moving averages is where most of them will say what up. So for Tesla, that could be $400 Tesla. Do I really think that's likely? No. Is it possible? Maybe. For Amazon, I mean, we're at our 200-week moving average for Amazon. Not a horrible place to be averaging in if you're a moving average buyer, if you like using moving averages as an indicator. Google could potentially have more downside ahead, but it's getting a nice bounce off of its 100-week moving average. But CTR has been a yielding defensive stock through this period. Defensive stock is in military defense. I'm not familiar. Oh, defensive is in actual defensive against this risk off. Yeah, energy stocks or anything relating to commodities have definitely been appreciating in a risk off environment. That's a good find though. I mean, just look at crude oil prices. I mean, crazy, right? Oil's been on a real joyride the past 2 years between nobody needing gas at all to everybody needing gas really badly. But yeah, so again, coming back to this, look, are Powell's comments promising? To some, if you take them seriously and you think that he's speaking honestly, which I'm not trying to say that he's a liar or anything, it's just he's in a very difficult position, and he also doesn't control the economy. So I don't, he's still a human at the end of the day, so you just got to take his words with a grain of salt. But says he's, there's an extent to which the Fed is going to be hawkish. Inflation should start to roll over relatively soon, and it is possible that we'll have a soft landing. Markets liked all that news, right? So they rallied in the face of that. But does that mean that the markets are just going to be back to bull mode and we're going to be, hitting all new all-time highs within the next 3 to 6 months? I don't necessarily think so, right? I think our two options is we do see further downside and maybe a legitimate capitulation. I personally would be a pretty big fan of a legitimate capitulation, honestly, for no other reason that I think it'd be temporary pain and be a lot of great places to buy stuff. And we might just chop sideways for a little bit longer as the market continues to be uncertain about Russia and Ukraine, as the market continues to be uncertain about inflation, as our economy right now continues to contract, right? I mean, we had a decrease in GDP. I'm not saying that Q2 will also show a decrease in GDP, but it's totally possible. Decreases in GDP do not happen very often for the American economy, right? It shouldn't be taken lightly when it does happen, right? I mean, we're still dealing with historic inflation, even if it does begin to roll over. So, with this uncertainty, maybe we've priced in the rate hikes, maybe we've priced in the inflation, maybe we've priced in World War III. I'm not sure. That might be what the last 6 months of bearishness in the markets have been. And as a result, we might just chop sideways for a while until we feel confident again. It's also not the worst thing in the world, right? Chopping sideways just means it's a great place to dollar cost average before the next move up. Same logic as a capitulation would be, in my opinion, right? But what I don't think is going to happen is this rally is just going to sustain and we're going to be right back to all-time highs. Is it possible? Sure, but I would just take it with a grain of salt. And again, still not a horrible place to be in the market, right? We're already down pretty substantially on a lot of tech stocks, on a lot of indexes, on a ton of crypto, right? I mean, a ton of crypto. Crypto's ugly. I mean, Polkadot, one of my favorite assets, right? I mean, we're down, I think, 65% from all-time highs. Worse, 69%. At its worst, it was 75%. Continuing the dollar cost average in because I believe in the asset. I think it will appreciate in the future. Yeah, Algo had some great. What was it? Did FIFA, I think, say that Algo is their official currency for, or they're doing a partnership or a sponsorship. Algo's pretty good tech too. I do like Algo. But yeah, that started rallying a few days ago, and that rally is just continuing to sustain itself with this positive FOMC news. But yeah, so markets like this. Guard has been on a tear. I have not looked at Guard before. Come on, TradingView, you got to have it for me, right? Maybe it doesn't. Sorry, Greg, I don't know if TradingView has Guard, unfortunately. I'd love to do some analysis on it. But yeah, I mean, this is the best, bounce with the crypto market we've seen since this, this crazy rejection off of the 200-day moving average, which I think kind of solidified a lot of bearishness for me, right? So that's why, look, in my opinion, a capitulation is more likely than anything else, especially in the crypto market, but in general markets right now, just because of all the uncertainty and because I think people just want lower prices for those that aren't fearful in this market. I think a capitulation makes a lot of sense. But who would I be to be all Mr. Laser Eyes till 100K if I didn't share some hopium? Been sharing this on my Twitter. So what you look for in assets suggest a relatively bullish pattern. It's the good old cup and handle, and my drawing of it might not be great here. Handle is a bullish pattern in which there is a rounding bottom and then a correction and then up, right? And again, I think a capitulation is more likely, but laser eyes to 100K. Here's a little hope for you guys that maybe we just go sideways for a few more months, like I said, and then just start slowly creeping our way up. And then we're right back to our regularly scheduled program not long after that. So that's what I'll leave you guys with. And yeah, like I said, shorter stream today, but I mean, heck, we still went about 35 minutes here. I know they usually go for about an hour, but I really just wanted to cover the Federal Reserve meeting today, Jerome Powell's comments, what they could mean for markets, what the potential outlook is. Are we in reversal mode yet? I don't know, but I wouldn't be waiting for a reversal and a bull run to start averaging into the market if you like averaging into the market, right? I would say that the more bearish that conditions look, the better it is to be averaging into the market, right? That's why for this logarithmic regression band that I use, go to the weekly time frame, go to my other Bitcoin chart, my bad, right? This is color coded not only because it's my buy zone, but because for each different band that we go into, my dollar cost averages get more aggressive, right? So if I'm dollar cost averaging, say 5% of my paycheck in right here, maybe I'm dollar cost averaging 7% here and 10% here or something like that, right? So just something to consider, right? Like if you're really in this for the long haul and you're young and you're just trying to grow your wealth, then you should be, totally blind and ignorant to all of the noise of the media and the Federal Reserve and blah, blah, blah. And you should just look, are these historically lower prices or historically higher prices? And do I believe in this asset? Because if that's the case, then you should just be averaging into the market and not really paying attention to much. And when things look dismal and when there's blood in the streets, when you should be averaging into the market heavier. Again, not financial advice, just, strategies that have panned out for me and might pan out for you. Anyways, guys, I hope that you enjoyed this lesson, this stream today, and we will see what the Federal Reserve does next, and we will see how the markets react. Hopefully, these takes don't age like milk. Have a good night, everybody. Peace.